This is Will McCauley with cEntellect. I'm going to review this week's crude market highlights. After being bearish for 27 weeks, given the recent price declines, we decided to take our position flat. Right now I'm going to discuss fundamental drivers as to why you could expect more bearish fundamentals, but we think the price has begun to reflect a lot of the issues that we thought were missing from the market price. So the first factor is the US dollar remains strong. It's up 8.8% over the last 30 weeks. And there's an inverse relationship between the US dollar and crude prices. As the US dollar rises 1%, crude price typically declines about $2.75. The second is we just finished week 7 of the build cycle. And so far through this build cycle, we've averaged 6.6 million barrels a week of storage gains. That compares to 2.3 million over the last 5-year average. So we're injecting and storing a whole lot more crude oil than we typically do during this time of year. The third is US demand was down about 200,000 barrels a day year on year. That's 1.6% down, so weak US demand. The fourth factor is US production was up around 700,000 barrels a week, week on week. So strong production gains continue. Fifth is leased to commercial stocks. We're up 3.8 million barrels a week, week on week. And the sixth factor is US exports were down 2.5 million barrels week on week. Next, I want to turn over to how the trade has performed since inception. So as you can see here, we're up 21% unlevered since we initiated the position in May. We've been bearish most of the time. There were a couple of periods where we took a neutral stance, but have remained neutral and or bearish. Given the declines that we've seen over the last approximately 6 weeks, from a high of around 76.50 down to 56.50 a barrel, that is where most of the gains have come, as we think the market again has started to realize the oversupplied situation that the world is in. So for much more detail on our view and our fundamentals, please visit us at cEntellect.com.